As investors, it's great when the major indexes are trending higher with stocks breaking out left and right. If you trade the IBD way, you know that strength begets strength, and a strong stock market that's hitting new highs and trending above key moving averages is a market that you want to be participating in. But nothing goes up forever. Markets shift and change, headlines shake up investors' nerves, pullbacks and selling will definitely occur eventually, and these things can happen by surprise. This is why in bullish markets, it's not the time to abandon your rules. In fact, it's time to double down and make sure you're trading with a measured and prudent approach. One of the most important rules that you must honor are your buying rules. Technical analysis is crucial to stock picking. Buying rules are a key part of technical analysis. They clue you into whether it's the right time to buy a given stock or not. They help you manage risk by buying with the highest chance of success. As a quick overview, the best time to buy a stock is when it's clearing a proper buy point. After a stock has established a floor of support and builds the right side of a chart pattern, it will eventually run into a new ceiling of resistance. That becomes the new testing ground for the stock. So will it bump its head against the ceiling and fall back down, or will it punch through that ceiling in big volume and break out to new highs? That line of resistance establishes the ideal buy point. If the stock has the power to punch through the ceiling in strong volume and market trends are favorable, chances are high that the stock is ready for a new run. Now, once the stock has moved far enough past that buy point, it's no longer a good idea to buy it. This is because the stock is now extended from the buy point. It may sound like an easy rule to honor, but the fear of missing out can be real when you see a great opportunity just a little too late. This is why I'm turning it over to IBD's senior market strategist, Mike Webster, to talk a little more about what it means when a stock is extended and how to best toe the line between buying into strength and not chasing a lost opportunity.
Buying extended stocks, sometimes you have to do it. That's the reality of it, but you don't want to make it a habit. And if you're on the newer side of trading, you probably shouldn't ever do it. It's more something you can do when you're advanced. So I'm going to be talking about this because Bill would buy extended stocks at times, but they would have to be very special, and it would have to be clear that this is, has the potential to be a market leader. And if you're buying extended, you have to have a maximum loss in place. So let's assume you are buying something sky high up and really extended. You're taking on a tremendous amount of risk that a normal fluctuation in that stock is going to stop you out. So you want to use, at least a 7% max loss. And you don't let it get beyond that if you're buying extended. But again, newer folks, if you're in your first 3 years of trading, just buy as close to the pivot as possible. Maximum distance from that pivot should be 5%, and you should really try to get it as close to it, like within 1 or 2%, if at all possible.
A rule of thumb for investors just starting out is to never buy a stock 5% beyond the buy point. Anywhere between the buy point and 5% above it is fair game, but after that, you should try to avoid buying. Stocks often pull back at some point after a breakout, so if you buy extended, there's a higher chance that you'll get shaken out of the stock.
And the reason for that is just the normal fluctuations of a stock. When they ebb and flow, you maybe you go up 3 or 4% and then it comes down 1% or 2, and then it goes up 2 or 3% and then comes down 0.5% or percent, and that's in the best case. But in the worst case, you get days like we had this week where you get, growth gets hit really hard, and anything that you would have bought extended prior to that, you're going to have to sell to manage risk, and most likely those things are going to just turn and go right back up without you. So it becomes a frustrating thing and psychologically more damaging really than to your account. If you're always cutting your loss at a maximum 7%, whether you're buying something precisely at the pivot, which should be the goal, or you're buying a leader that got away from you, you still have that same amount of dollar risk on there, but you also want to preserve your mental capital. And getting shaken out of a stock that turns and runs and has a big move because you did something wrong by buying it at extended, that has a way of just kind of throwing you off balance and getting you out of the zone. And the goal with trading is to stay in the zone, because it's much more psychological than it is technical. It's about your emotions, controlling your hope, fear, and greed, and not having that fear of missing out. These days, FOMO is talked about all the time, and there's a reason for it, is because you see a stock that runs up without you, and you think that everyone else has it. Everyone else doesn't have that stock, so don't they might say they have it, but how much size do they have, and all of that. It is that fear of missing out you have to get over, because Bill O'Neill would always, the founder of IBD, would always say, you can't kiss all the babies. You can't get every last one. Now, everyone has FOMO. It's whether you admit it or not. We all have it. All of you have it. Everyone listening has it. And it's what rules you have to control the FOMO. And so for me, I found spreading it out and starting off with more, smaller positions that then allow me to add to them if they are working and not too extended. But I would say that the best thing someone can do to improve their trading is to find the exact pivot. You have to know exactly, if you're not going to buy extended, you have to learn how to read charts, and you have to know exactly where the pivot is.
Indeed, you have to know where the pivot is. Pivot being another term for buy point. The good news is there can be more than one buy point. Oftentimes, a given chart can offer various official buy points depending on how you interpret the base formation. You can have a base that lays itself out as both a double bottom and a cup with handle. These happen a lot more than you might think. Additionally, investors should pay attention to alternative buy points.
Almost every chart will give you multiple alternative pivots, meaning upside reversals, prior resistance in the base or in the handle, downtrend lines, of ways of getting a head start. And so most folks should learn how to buy those alternative pivots, and those are not, by definition, not going to be anywhere near extended. Sometimes the way the data will fall, the price data will fall, that a standard pivot is really at an extended point. And when people are new and don't realize that, and you're just buying the standard pivot, it is extended, you get shaken out all of the time. So that's why I lean, if at all possible, I will do alternative pivots and then add to them at the standard pivot as a way of pyramiding in. But that's the way I like to approach it.
Once a stock breaks out from a buy point and moves out of the 5% buy zone, it may pull back to a key support level, such as the 10-week or 50-day moving average. A bounce from this level would offer yet another alternate entry. Another thing to keep in mind when figuring out if a stock is extended is paying attention to where the stock is relative to its moving averages. You can always look at the moving averages and see, percentage-wise, how far above them the stock is. For example, let's take a look at Shopify from July 2025. The stock broke out from a cup with handle base, but then pulled back. The stock has struggled to move beyond the 5% buy zone so far, so we can tell it's not extended from that entry. We can also see on Market Surge that the stock is only trading roughly 6% above its 50-day moving average, which is safe to say not extended. Now compare that stock to another stock like CoreWeave. Using Market Surge, we can see that as of July 2025, the stock is a whopping 32% extended from its 50-day moving average. That's quite high and shows that the stock may be at higher risk of pullback. Some traders will use the 21-day as a measure of extension instead of the 50-day or 10-week line, depending on the stock and their trading style. The closer to that moving average, the better, especially for a shorter-term moving average. The reason? A stock is considered extended from a moving average once it's more than 5% or even 10% above that level, if you are using that moving average as your line in the sand to sell. Ultimately, not buying extended stocks is a matter of risk management and is especially important in times of market strength, when euphoria and fear of missing out are running hot.